positive on the China banking sector as the inflation rate coming down, which gave the government a more policy option, for example, monetary easing to ensure an economy soft landing. We think the de-rating of the sector has always been governed by the fears of hard landing, the fears of asset quality deterioration, and the fears of fundraising. But with the policy fine-tuning, we think these fears are unlikely to be realized in the next 1 or 2 years. And the visibility of the earnings and book value of Chinese bank will be greatly improved. And we think the loan growth and earnings sustainability might surprise the market, which can serve as a share price catalyst in this year. We think the Chinese banks can maintain a low-teen earnings growth in 2012, driven by about 15% loan growth, a stable NIM, and a stable credit cost. Although we expect the NPL ratio to increase this year, but we believe the bad debt reserve that banks have built over the last few years can provide a very strong cushion. Our sensitivity shows that the earnings and excess provision cover about 6% write-off of total loans, or nearly 20% write-off from the riskier sector, for example, LGFVs, developers, and small enterprises. So in the volume-driven environment, we like large banks more. We think the outperformance of small banks last year will reverse because the cost of growth at those banks is going to be higher. Those banks have a disadvantage in their deposit franchise, in the capital position, or the capital efficiency, like a lower return on risk-weighted asset. Moreover, an ease credit environment is unfavorable for the pricing power, which was one of the major reasons for the outperformance of small banks last year. We downgrade CITIC to hold, and we have upgraded Bank of China to buy on U.S. recovery and the strengthened U.S. dollars. So our topics in the sector are ICBC and China Construction Bank.